So before we jump into this lesson, guys, I want to talk about a recap of where we are because although it might have seemed very obvious and very simple what we just talked about in the last video, it's really, really important that you have a very clear understanding of it because this whole entire course builds off of one another. So if you don't understand and you don't get why certain things are happening, it's really important that you do get it. So, excuse me, we were talking about how we value and how stocks get priced, right? My argument is that we cannot do that. Now, normal conventional wisdom will say the stocks are priced off of two things. They're number one, priced off of forward earnings. So, how much money a company we think, or anyone will think, a company will make in the future, and then you add some sort of multiple to that, and that becomes the value of the stock. And my argument that I mentioned a lot in the last video is that changes every second of every single day. We have geopolitical issues, we have CEOs going crazy, we have the US dollar or gold doing something that isn't supposed to be doing. So, forward earnings to me is not something that could actually ever be valued because it changes all day, every day. Obviously that's why prices of stocks fluctuate up and down all day, every day, is because everyone's trying to continuously put a new value on the company based off of all these other external factors that are coming into play. And the second thing they're priced off of is the risk-free rate of return. So the risk-free rate of return is the cushion or the padding that the market gives to its participants. It pays them to take the risk as opposed to just putting their money in a risk-free rate of return asset. So if a risk-free rate of return asset right now is at 5%, equities over the course of a year would have about a 5% padding to the price of the stocks. Again, the market is thanking you. It's paying you for taking that risk of investing in the stock market compared to not taking any risk and getting that 5%. However, nowadays, the risk-free rate of return is about zero. So right now, the market isn't really paying anything at all to investors to take that risk when compared to just putting their money in a risk-free rate of return account. So my argument is, because we can never actually predict forward earnings, and because right now, as we stand here today, and if it changes, I'll change this video, but as we stand here today, the risk-free rate of return is zero. Those being the cases, that means that that we can't actually value anything, and that price is completely random. Price is completely 50-50 in terms of a stock going up or down. If Apple's at $150 a share, it could go up to 151 cents, or it could go down to 149.99. That in itself, if there's nothing in between there that gives one edge to one side or the other, it's completely 50-50. And 50-50 is completely random. So that's where we are right now. We're going to go ahead in this video and show you actually what that even looks like. So what we can visualize it actually, which is like kind of cool. We had some of our support people look into this. It's actually like kind of cool how you can visualize it. So there's going to be a little bit of math involved here. It's nothing crazy. I'm going to explain it really, really basic, but it will prove a nice point. So what do random stock movement looks like? Again, we're going to visualize and we're going to prove to you that stock movements and price movements are completely random. So what is this? Does anyone know? Well, I'm sure some people have seen it before, but let me explain exactly what this is. This is a normal distribution curve. This is something that's known in the mathematics field and the way we think about it is the following. We have this slow slope to up and then down again with some numbers on there. Let me explain it. The dark blue area in the middle, where on the left side says 34.1%, on the right side says 31.1%. Together, that is 68%. That's known as 1 sigma or 1 standard deviation. So what a normal distribution curve says is that in a random setting with enough occurrences, wink wink, remember we're building on top of what we learned before, in a random setting of random occurrences with enough occurrences, just like a coin flip, all that stuff, all 68% of occurrences will fall within 1 standard deviation, right? So that's all that means, nothing crazy. So again, in a random setting with enough occurrences, right, 68% of the occurrences will fall right here within one standard deviation, right? So that totally makes sense. Now, what does it say once we go out that? It's a little bit different. So once we go outside of that, let me see. Let's do some quick math. So we have 68.2, 27.2. That's like 90 something. Actually, I'm gonna have to do this because I don't know what I'm doing. So 68 plus 68.2 plus 13.6 plus 13.6. So what they're saying is 95.4% of occurrences, 95.4% of occurrences will fall within 2 standard deviations. Now again, 2 standard deviations is 2 times the expectation. So 68% of the time in a normal distribution curve setting. So again, random occurrences. And we just showed you, I just gave a big speech on how I think stock prices are random. That's why this comes to play in here. And enough occurrences, remember, we want to have enough occurrences to make sure that the probabilities we set out to have are accurate at the end of the day. But 68.2% of the occurrences will fall within the expectation or 1 standard deviation. 95.4% of all these random occurrences will fall within 2 times the expectation or 2 times the expected move, and so on and so on. So a lot of you are probably saying, well, Stephen, what the hell? Like, what does this have to do? This isn't a math class. This is Market Hero. We're trying to make money here. What we have done is we have taken stock price movements from some of the most popular names, and we have drawn them in a chart similar to this. So what we did is we went back for I think just 2 years on this study, and we got the percentage move every single day for a 2-year period of each of these stocks. And all we did was put it in a similar chart like this. Now, again, I want to go over this chart again real quick. A normal distribution curve says in a random setting with enough occurrences. Remember, we're building on what we were talking about before. Random is the fact that, again, stocks are priced off of 2 things. Forward earnings, which we cannot predict, and the risk-free rate of return, which right now is 0. That makes all price movement 50-50 or random. So in a random setting with enough occurrences, remember, we have a lot of occurrences to make sure the probabilities that we set out to have become accurate. So this is all building off one another. So a normal distribution curve says, with enough occurrences in a random setting, 68.2% of all occurrences, or the way you can start thinking about it now is price movements, will fall within the expectation or 1 standard deviation. And then what was it? 95.4% of all occurrences will fall within 2 times the expectation or 2 standard deviations. So remember this screen, guys. Remember this screen. This is pure math. This has nothing to do with any external forces or economics or balance sheets or nothing. So the first one we're going to look at is SPY. So SPY is the index ETF for the S&P 500. Right? So the S&P 500 is the #1 most followed index. It's a basket of 500 stocks from all different sectors. It gives you a nice understanding of the overall stock market. If we took the percent daily moves in a 2-year period, how dissimilar is that? Now, it's not exactly the same. I'll give you that. It's not exactly the same, but it's not too different. We have a lot of information wrapped around that 0 line, or the way you could think about it is the expected move. So if we think about it this way, let's draw some lines here. How do I draw a line? That's not how I draw a line. A line. I want to draw the line. Let me draw the line. There we go. So imagine we have this. Now it looks a little bit similar, right? Now it's looking very, very similar. So what we're seeing here is this is the market. The market had gone up in that time. 2015, 2016, the market was up about 30% combined. Like, this means to me, this is just, not only did we already think that the stock prices are priced off of forward earnings, which you can't predict, and the risk-free rate of return, which is right now 0. But now we're actually visualizing, remember, the normal distribution curve. The normal distribution curve is based off of random occurrences. random occurrences, and they're going to fall within the expectation 68.2% of the time. They're going to mostly follow this visual pattern. This is the S&P 500. It follows very, very closely to that. Now, what about another index? Let's say the Qs. So the triple Qs are, excuse me, the triple Qs are the index ETF for the NASDAQ. The NASDAQ was up quite a bit in those 2 years. However, looking very, very similar to not only SPY, but also the normal distribution curve. It's crazy, guys. This is a 2-year period. That's a big enough sample size. The market was up in this time, yet it still looks like we are following a normal distribution curve when we look at the NASDAQ and the SPY. It's just absolutely crazy stuff. It's absolutely crazy stuff. So let's look at some more stuff because this is really, really important. Let's start looking. We've been looking at indexes, right? So we looked at SPY and it definitely looks like a normal distribution curve. There's no question about it. Then we looked at the Qs, which is definitely looks like a normal distribution curve. What about like a stock? How about Apple, since we already talked about it? Remember I asked you last lesson, what are the chances Apple's go up? And here we go. Now this is really starting to get interesting. This is a stock. This is a stock that has gone up significantly in that time, almost 50% in that time, looking very similar to a normal distribution curve. I mean, I think what would be nice if I started doing this, and I just copied, and then I would just add them here. There we go. I'll do it with all the other ones. But again, very, very similar. They're very, very similar. The normal distribution, this is, again, Apple was up 50% in this period. 50% in this period. However, its price movements completely random because they mimic the normal distribution curve, which is based mathematically, scientifically proven off of random occurrences falling within this normal distribution curve pattern. It's so crazy. It's so crazy, but it's so cool. It's so powerful. Let's look at another stock. Let's look at ConocoPhillips here. So ConocoPhillips is an oil stock. Now, this looks really similar, really similar to the normal distribution curve, right? This is almost dead on. It's mind-blowing. It's absolutely mind-blowing here. Again, these stocks go up, they go down. Like it happens. However, they're all looking exactly the same for the most part. They're all looking exactly the same for the most part. Actually, let me go back and there. And I'm going to go forward. Don't look. Close your eyes. Okay. Right, they're all really following similar patterns. Remember, the normal distribution curve is based off of random movements, random occurrences, right? And we have said that stocks are priced off of two things that we cannot ever predict, and they don't add any value. Thus, everything is random. Normal distribution curve is random occurrences. There's SPY. It looks really similar to a normal distribution curve, which would mean that the price movements then are random. The Qs, the NASDAQ, looks very similar to a normal distribution curve, which means price movement in the Qs has been random. Same thing with Apple. Apple, the biggest stock in the world, the most successful stock in the world, the most owned stock in the world. Like, this looks like a normal distribution curve to me. Like, I have 2010 vision. I have vision like a jet fighter. From my baseball days, I had good vision. But I have like vision like a jet fighter and like an eagle. Like, this looks pretty damn similar to me. Does this not give even more proof that price movement is random? And then ConocoPhillips, one of the largest oil companies in the world, one of the largest commodity companies in the world. If it looks like it and talks like it, it probably is. Remember, the normal distribution curve is for random things, right? These price movements look pretty damn random to me. And let's look at another one, a commodity like silver. Like, guys, no one can tell me with a straight face, that this does not resemble almost to the T a normal distribution curve. Again, normal distribution curve is random occurrences, right? So, let me add another slide here real quick. I'm going to do this on the fly. So we're going to duplicate this slide. We're going to get rid of this. We're going to get rid of this. We're going to say, what do we do with all of this info? No, whoops. Right? So now, again, we've looked at all these, we've looked at the normal distribution curve. We know what a normal distribution curve looks like, and it's for random occurrences. If something ends up looking like this on a data set, that tells us that the occurrences are very, very random. The S&P 500 looks pretty damn random to me. The NASDAQ looks pretty damn random to me. Freaking Apple looks pretty damn random to me. ConocoPhillips, silver. But what do we do with this? So great. Now we know a few things, right? So we know that that prices are random. So now that we know that, what do we do from here? Well, one of the big things of becoming a market hero, and one of the big things that we teach here in this course, is that you can't predict if a price is going up or down. You don't know that, right? And because that, you don't want to make that type of a bet that a stock is either going to go up a penny or down a penny. Betting that a stock is going to go up a penny is the same exact thing as just buying a stock outright. We don't want to do that. Remember, we said that one of the key things that you have to do to make money in this business is always have odds better than 50-50, right? Always have odds better than 50-50. In silver, did you really ever have odds that are better than 50-50? Not really. It resembles very much a normal distribution curve, which again is random occurrences. So if these stocks are random, if they're completely random, why would we ever make these 50-50 bets? Right? Why would we do that? Right? Remember the forward earnings are unpredictable. Right? Bull. And the risk-free rate of return is 0. So because of that, prices have a 50-50 shot of going up or down, right? So prices have a 50-50 shot of going up or down. That's why they end up looking like this, and this, and this, and this, and this, right? Because it's completely random. So what do? Well, number one, no one can predict anything in the stock market, right? And I think we've proven that. And if we haven't done a good enough job proving it, take a look again, because this is all the information there is for it. So if price has a 50-50 shot of going up or down, why would we ever place a bet where we would then have those same probabilities, right? Buying stock outright is placing a 50-50 bet that you're going to make money because price is random to go up or down, right? So it's completely random here. So we would never make those bets. Remember, putting a value on these things is unrealistic. Forward earnings are unpredictable. Risk-free rate of return is 0, right? Because of that, we have price movements, no matter if they finish a year up or down, look very much like a normal distribution curve across the board, guys. They wouldn't look exactly like they do here if they weren't random. If stocks, quote unquote, always went up, they wouldn't look like a normal distribution curve that is mathematically created to prove random occurrences. So again, everything later on in this course is going to build on this, but this is really, really important, because the truth is you never know anything. You never know a stock is going to go up. You never know a stock is going to go down. Later on in the course, we're going to show you how to use options to create occurrences that are better than 50-50. Remember, that's one of our rules. And the cool part is those are all priced perfectly in there. So there are a lot of strategies that we're going to go over that will not benefit by a stock going up or down by a penny. So that's why we're going to use options. Remember, buying stock outright, I can't say this enough, buying stock outright is a 50-50 bet. We're never going to make 50-50 bets. Options are the only way. Let me repeat that. Options are the only way where you can improve your odds, and not only improve your odds on order entry, but you can continuously improve your odds for the life cycle of that investment or trade. So again, guys, price movement is random. We can't predict if something's going to go up or down. Because of that, we never, ever, 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 ever in a million years buy or sell stock outright, because it's a pure 50-50 bet. You would never, ever, ever bet me in a million years on a 50-50 bet. So I will see you guys on the next video.